Welcome in. I'm Casey Gregersen. On behalf of Bighorn Capital, we're presenting today our latest investment, the Lilac Way investment. So if this is your first time ever watching one of our videos, what you can expect is we're going to dive deep into this deal. We're going to be very transparent on the underwriting, on the due diligence, how we found the deal, and just really give you a holistic picture of it. And then at the end, you're going to see next steps, what it would look like to actually invest in a deal like this. If you're coming back, I think this is going to be a really cool video for you guys to see another deal. Because guys, when I show you this deal today, this is a very, very unique one. Because typically when it comes to investing, you're either doing debt or you're doing equity. You kind of have to pick and choose, and there's advantages to both. The beauty of this deal is you're going to get the security of the debt, but you're going to get some long-term equity upside on this deal. So it's a really unique one in that way, and I'm really excited to show you guys. Moving along, this is our disclaimer. I'm not going to spend too much time to read this, but very important that you guys do understand this is an investment. So to give you guys a little bit of background on myself, this image I like to show. I typically show it at all of our presentations to share a little bit about myself, right? I worked for 12 years for Shell Oil Company. I actually graduated from the University of Wyoming in 2010, and that's actually when I bought my first property while I was at school at the University of Wyoming. So I bought that first property in Laramie, and over the years, we've really built this integrated real estate company. But people kind of ask, like, how did you do that while you worked at Shell? Well, I had the luxury of working in the field where I went for 2 weeks on a drilling or a frac location, and I worked for 2 straight weeks on the rig or on the frac spread. And then after that, I'd have 2 weeks off, and I wouldn't even have to answer my phone or answer an email. I had completely off, and that's what allowed me to start to build out my real estate companies. So the first kind of big company I built was Gregersen Properties. That was just my management company to where I managed all of my units and all of my portfolio. We eventually built that out, and we now scaled that with virtual assistants and our boots on the ground contractors. The next kind of phase was WIO Houses. You see that logo here. That is our direct to seller company, which sources all of our deals. That one, they've all been game changers, but that's been a big one. And then the third company is Revive. This is our construction company. After years and years of working with general contractors and subcontractors and just facing a ton of hurdles, and also just in the markets we work in and invest in, there's not a whole lot of contractors, so there's a lot of competition for them. So what we did is we went out, we built our own construction company. So that was the third vertically integrated part of our company. So why do I share all those 3 different companies in the vertical integration of our company? Well, we are combining all that into Bighorn Capital Fund. So our investors get to take advantage of our vertically integrated company, of our deal flow, of our property management team, of our construction team that can come in and be reliable, can be on budget, can be on time. All these things combine into what makes Bighorn Capital Fund. The other big part about Bighorn Capital Fund is we are targeting single family and multifamily investments. Today, we're going to show you a deal that is a multifamily investment, but our strategy has always been focused on residential real estate. The areas Bighorn Capital Fund focuses in is obviously Wyoming. That's where I grew up. That's been our kind of core market, right? But we've now branched out into Montana, also Nebraska, and South Dakota. We always look for properties that have value add potential. You guys are going to see this deal today, which is one of the best value adds I've ever seen because of how much work needs to be done. And it's a big reason why we found this deal. The beauty of what I've created with those vertically integrated companies, from being able to find the deals to fixing it up to property management, is we're now giving Bighorn Capital Fund and limited partners and investors who are accredited the ability to actually go invest and reap the benefits of all those different companies. So we're always looking for value add opportunities. You guys are going to see today on this investment, this is one of the best value adds I've ever seen because of how much work that needs to be done. But unless you have contractors and crews to be able to come in and fix things up, you definitely don't want to go take on a big project like this. But when you can do that, you can force a ton of value and it can create a ton of long-term wealth, really. And it's going to allow us, when the strategy on this deal is going to be talking a lot about, we're going to go and refinance this on the back end. So how does this all tie into Bighorn Capital Fund? Well, when you're a limited partner or an investor, and I do have a little note down here, we actually work with accredited investors on these deals, and often they could be debt or they could be equity. But those investors are going to get access to our vertically integrated company, right? They're going to get access to the deals that we're able to go find, fix up, and do property management with. But the other big piece of what we've really made, it's really been our niche over the years, is now the markets we're in. So we talk about Wyoming all the time. That's where I grew up. I've talked to people across the country about the numbers, the cash flow we see, the appreciation, the opportunity cost. There's just so much opportunity. I feel like to me, Wyoming has really been the blue ocean for us. But now we've expanded into Montana, South Dakota, and Nebraska. But when we're looking for deals, we're always looking for value add. We're typically looking in single family and multifamily. This deal today is going to be a large multifamily of 45 units, and it's going to have a value add component. Guys, when you find value add deals, it's just a great way to go in and create a ton of value for both myself as the operator and also for our limited partners. If you're new to value add investing or just new to the multifamily game, it is crazy how much the numbers can change when you start to look at your expenses and your revenue slash profit. One of my favorite parts about investing in multifamily properties and value add is the control you can have over driving the actual profitability and value of the project. So this slide kind of shows the impact on the expenses on a multifamily property. So when the way a multifamily property is evaluated is based on the net operating income. So the net operating income can obviously be reduced by reducing your expenses. So this kind of shows you, like, if you just go and cut your expenses, in this one it was like a 16% decrease, you start to see the big value that you create on the exit of the property, right? Now, this also holds true when it comes to the revenue of the asset, right? If you go up and raise rents, or in this scenario, if you just go increase occupancy, that increases your NOI, your net operating income, which ultimately increases the value of the property. So I love this. Why this excites me is when you're flipping a single family house, you're at the mercy of the market and your competition, right? You're looking at your neighbor's house and the neighborhood. A lot of factors that you can't necessarily control. But when it comes to multifamily, you can control a lot of the factors because you can go raise the income on the property. You can go cut the expenses and make it more profitable. And the more profitable you make, the better the value you have on the back end. Now let's dive into this deal. So I want to kind of show you kind of the bird's eye view of these 45 units. So this is 8 different buildings, 8 different lots, and it spans across 1.61 acres. So you guys can kind of see the layout there, located in Evanston, Wyoming. Now let's talk about Evanston a little bit, and I want to kind of show you geographically what we're looking at. One of the biggest things is affordability, and I kind of highlighted it on this slide. You can see Evanston, and it's right there by the border to Utah. And if you cross over into Utah, all of a sudden things become very unaffordable. I kind of showed some of the statistics there in Park City and the cost of a home. It is night and day when you're compared to what's at Evanston. You also compare that over into Salt Lake City, one of the big metro areas here now in the U.S., a fast-growing market. But it's becoming unaffordable for people, and there's a lot of people that would choose to actually live over in Evanston. You can kind of see the proximity. You're looking at like an hour drive from Salt Lake or Park City over into Evanston. And surprisingly, or maybe not surprisingly, there are people who would rather commute in, live in Wyoming, where it's a fraction of the price. You're literally looking at about half the price from Salt Lake to Evanston on average. And they're literally willing to commute. The other thing is there's a lot of tax benefits in Wyoming. Wyoming has no state income tax, and they also have very low property taxes. You typically don't get both of those. For example, in Texas, there's no income tax, but property taxes are very high. So you typically don't get both of them, but you get both in Wyoming. A couple other things though on location, you can see this area of Evanston. If you go to the east, you're going to see Green River and Rock Springs. And to the north, you're going to see Kemmer. And I want to show you this area is growing rapidly. There are a ton of jobs. And I want to show you guys a couple headlines here. So the first one here on the left is a $6 billion trona mine that's coming in. So this is going to be outside of the Rock Springs, Green River area. It's going to bring a ton of jobs, and all these people are going to need somewhere to stay. The second one is this one's probably the one that excites me the most. This is a nuclear plant being driven by Bill Gates. If you guys have been following what Bill Gates has been doing, he's been really pushing nuclear. And one of the sites that they're going to go build this nuclear plant on is in Kemmer, Wyoming. So Kemmer is probably 30 to 40 minutes away from Evanston. And Kemmer is a very, very small town. There's hardly anywhere place to stay there. And honestly, if you're living there, no one's going to want to live in Kemmer, right? Evanston is a little bit bigger town, has a lot more just stores, a lot more options for those workers. So a ton of people are going to be flooding into this area. To give you guys a little bit more perspective, in Rock Springs, which is about an hour away, they just got an approved a $72 million high school. They're tearing down the current high school because there's no way they can keep up with it. Plus, they're seeing this influx of money coming into the area, so they can actually got it approved to build a $72 million high school. They're also seeing this in Evanston. I've been talking to I talked to another investor who's tied in the school district, and he said they're planning on 150 students coming into their school district over the next couple of years. So when it comes to investing, guys, one of the most key things when people invest. I mean, if you look at like Austin, Texas, or some of these places that have blown up, that was driven by jobs. When jobs come in, people move in, and that drives real estate prices. That's fundamental 101 real estate. So this has one of the biggest drivers, and this is there's a lot of things that excite me about this deal, but if this doesn't get you excited, I don't know what will. Here's the last thing is I'm going to go into all the underwriting today. My underwriting is based on today. It does not include all this happening, right? This is all upside that is just going to increase the value and increase the cash flow of this property. So now let's talk about the deal and how we actually found it. So the source of the deal was a postcard. We do a ton of different marketing through WYO Houses. You can see our postcard right here. This lady actually called us. It was back on, we sent out this postcard in Q1 of this year, 2024. And we actually made contact. First contact, I went back and looked at it, was on March 5th. She called in, saw the postcard. And I actually worked with this lady quite a bit. My team takes the initial call, but then I got on the phone. And I spent hours with this lady because as soon as I got in and realized the opportunity of this deal, it was one I was going to invest a lot of time in. So we actually did our first visual inspection at the end of March. And then we actually sent the first letter of intent on April 1st. And we were actually under contract on April 10th to kind of give you a timeline how this deal came about and how we found it. The next step after we got this property under contract was the due diligence phase. This is extremely important. And if you're looking at any type of investment, especially investing a large sum of money like this one, you need to understand, hey, what went into the due diligence? So one of the first things we did is we got inspectors out there and they looked at the electrical, they looked at the plumbing, they looked at the roofs to look at a lot of these big ticket items. So we got them all out there. But the other thing we started to do is I went actually and I interviewed a lot of the contractors that had been working on this property for a while. Right? Because I'm always skeptical when I'm talking to a seller, like they're not going to tell me all the skeletons of this property, but you know who would? Is the contractors. And then this seller specifically told me contractors that she did not get along with. So who was the first person I called? I called those guys that they had issues with. So I called them to get, hey, give me the dirty on this property. Like, what are the issues? What are the potential like showstoppers that could pop up? The other thing I did is I started interviewing other investors local to the market, talking to property managers and real estate agents who really know Evanston, because I wanted to make sure, was there some history on this property that would maybe make it unrentable? I just want to uncover turn over all the rocks, just make sure we understand what's going on. The next two phases of the due diligence was actually us getting out there and walking the units. Since then, I walked a bunch of them myself, and now since then, my contractors and my team have got into nearly every single unit. Every unit that needs work, we've been in there and we've actually got a scope, which I'm going to show you in just a second. And then the last phase was the rental comps, which I'm about to dive into the numbers and show you guys. Now, before we get into the rents and all that, I want to talk about the forced appreciation and the value we're going to create. As I mentioned, we got into all these units that needed work. Here's a couple pictures you guys could see, all right? You could see some of the work. And now, guys, when I compare this deal across many deals I've done over 14 years, it is one of the best terms in a deal that I've ever negotiated. And you're probably asking yourself, well, why would you get such good terms? I'm about to show you that my seller is taking a second position mortgage. Like, why would somebody do that? Well, one of the biggest reasons is there's a lot of work to be done on this property. Of these units, here's a couple pictures here that shows you like how the condition of these units. Now, I've been investing for 14 years and I've seen a ton of deals and I've negotiated a ton of contracts and set up many different terms. But the terms I got on this deal, as I'm going to show you guys in a little bit, they're going to blow you away. And they honestly have never been this good. And you're probably going to ask yourself, well, why would the lady sell to you on these terms? Well, here's one of the big reasons is the condition of the property. You can see the scope right here. This is just a screenshot of all the different units. And we kind of went through every unit and we figured out, is this a big scope, a small scope, or a medium scope? And we kind of categorized them, right? You can see the pictures here, what's going on. But doing this big of a scope and this big of a project is a lot to undertake. And frankly, that's why the seller was ready to sell it. She'd been trying to get this thing fixed up, struggling to find contractors, and she was really honestly ready to be done. But what we did is, and guys, here's the other thing, is I identified this early on because you got to identify the risks. Like, what are the big risks of this project? Well, one of the risks identified was contractors. Who's going to go fix this thing up? Well, our solution was I actually recruited a crew out of Houston. So this crew got up here. Here's a photo from May 16th. So we're sitting here today when I record this video on June 2nd. This crew has been to work on this property for nearly 2 weeks. I actually flew up there, met them there, got them started. It's been super cool. These guys have gotten to work. They're going to do a great job. They're going to be staying there all summer and even into the fall if needed to get this construction done. So now we can eliminate that big risk and that big concern of how are we going to go find contractors? All the contractors are too busy and they're all overpriced. Well, our solution was we brought in our own crew. Now, as promised, I want to get into the rent rolls. So what we use the rent rolls for is this is going to drive how we actually predict the cash flow of this property and how we're going to predict what is the value of this property going to be once it's fully occupied and rented. I like to give 3 scenarios anytime I'm underwriting a deal. So my first scenario, as you can see here, is the base case. The base case is what we can depend on, right? Then the next case is the target. That's where we're shooting for. This is the numbers I really believe we can hit once we get our team in there and we fix these units up and we make this place a nicer apartment to live at. Now, the third scenario is a new one and a very unique one that this is the second time we've done this on a property. I've been talking to Rob Abasolo. He's out of Houston. He's one of the best short-term experts across the country when it comes to real estate. So we've been employing him and his team have done the same strategy that we're doing, where you take a big multifamily property and then you carve out maybe 10% of the units, maybe more, maybe 25%, and you use them as short or medium-term rentals. What you get when you do them as short or medium-term is, yes, you have a little bit more cost when it comes to furnishing the units, but you're going to get double, maybe triple the rent for these units. As that increases the value of the asset, because I'm going to show you later how you predict and actually start to estimate what the asset's going to be worth. But when you bring in these short-term rentals and bring in that additional revenue, again, it's going to increase your cash flow and it should increase your exit price when you go to sell the property. So again, to summarize, I've got 3 different scenarios. This is just a screenshot. Happy to show you guys the full list of all 45 units, but we've got a projected price for each one of those units. But how do we come up with that pricing? Well, what I did is I went, as part of my due diligence, I went and looked at all the other rentals in town. Here's like 5 or 6 different rentals that we went and looked at. I kind of shared the size of them. Actually, you can go click this link too and actually go see that specific property. But I wanted to go see what did the competition look like. And that's exactly how we came up. That's how we really came up with our base case and our target rents. And also the short-term rentals. We looked at that because there were a couple short-term rentals. But again, we run our short-term rentals a little bit differently than most other people do in Wyoming. And I think we have a nicer product and we just have better marketing to be able to go get higher prices. So now that we have the income and the rents and the rent rolls coming from the property, now this feeds into our investment summary. So big Excel table here. I'm happy. I've actually have a separate video where I can show you guys and really break all these numbers down. But I'm going to kind of give you a highlight of how this all pencils together, right? So again, remember, we've got our base case, we've got our target, we've got I call it our STR target, which is short-term rentals. So as you go down there, you start to see the values in each one of these scenarios. So kind of working top down, you got to look at the income, right? So I talk about, okay, how much rental income is coming in? That came from what we just talked about on the last slide. The next thing is we got to look at our expenses, right? So taxes, insurance, utilities, those are all things that we know. Utilities, that's one we've made an estimate on once we get in there, but we've done enough properties now. We feel pretty strongly that we've got good numbers when it comes to estimating utilities. Plus, a lot of the utilities, the tenants are going to pay for anyway. As you keep working down, you got to account for property management fees, you got to account for vacancy, and you got to account for repairs. So on those ones, we've estimated and we usually do that as a percentage of the rents. So that's what we found over the years in doing a ton of deals like this. That's the best way to go in and project that. So once you take out all those expenses, you come with what we call the net operating income. So net operating income is how much profitability, how much cash flow is this property going to shoot off? Okay. So we've got that in each different scenario, right? Now we're going to kind of keep working down and I want to explain how we actually structured the deal. Okay, now that you understand the net operating income, I want to explain the great terms that I talked about earlier in this video about these unbelievable terms I negotiated. So the cool thing about this seller is she is going to carry the majority of the purchase price. You can see the seller carry loan is $2.125 million. So normally a seller would carry that in first position. But again, because I built such good rapport and trust with this lady, and again, based on the asset and what needed to be done and the price we got it at, she's actually going to carry that in second position. What this allows is I'm going to be able to bring in my investors and our partners on this deal to be secured with a first lien position. So that's where the 1.6 million comes in. You can see that's going to be the private money loan in first position. Guys, if you invest in real estate and as a lender, the most secure way it is to be is in first position. Because if you play this out, like say we closed and something were to happen to me, the investors have a first position lien. The value today, if we got an as-is value for the property, we're estimating the as-is value before we spend any of that money on construction. The as-is value is probably 2.5 to $3 million. That loan, if you think about, look at that cushion between 1.6 and say 2.5, that's like a $900,000 delta. So if something were to happen to me, the investors would make out even better, right? But that's not the strategy of this. I'm going to keep going through that. But I wanted to show you the security of this investment. Again, this is unheard of. Sellers taking a second position that high. I've never seen it. And anybody I've told, and all the other investors, my colleagues, my peers that I've told this about, they've just been blown away on the terms we got on this one. Now that you understand how the terms work with the seller taking a second position loan and the investors being in first position, now we can kind of calculate the cash flow of the property, right? So I calculated both this in year 1 and in year 2. Because in year 1, we're going to have some vacancy. Right now, we're fixing up a bunch of units. So therefore, you're not going to have 100% of the rents coming in. So what we did to keep that very simple, and again, this is based on experience on the last project we just did. We predicted that we're going to get about half of the revenue in year 1. So if we get half of the revenue based on an 80-20 split, and to explain the 80-20 split, we're setting this up as 80% of the cash will go to the investors, and then 20% would go to the fund, right? So if 80% of that is going and we expect about half of that to come in year 1, we're expecting, based on that investment, 11 to 13% return, right? But the way I've set this up is because, again, it's first position. I wanted to set this up as a debt deal, right? I wanted to guarantee to our investors that they're going to get a fixed amount of 6%, right? So they get 6% fixed, but it's the minimum of that, right? It's either 6% or 80% of the cash flow. So this numbers kind of underwrites it. We're predicting in year 1, 11 to 13% is going to be paid. In year 2, if we even get that far, because I'm going to show you, we're going to refinance it, give the investor all their money back. But say it takes us a little bit longer, we go into year 2, once it's fully stabilized, the return there is 16 to 21% on the money, right? But here's the cool part about this strategy. Because I told you guys at the beginning, this is a hybrid between debt and equity. Well, what does the equity look like? Well, what we're going to do is in year 2, we're actually going to go and refinance this. Now, as mentioned, this deal is really unique because you get to be secured with debt, all right? You have a 6% fixed rate. You have more upside. But the cool thing is I wanted to give investors equity as well on this deal. So what happens is within 12 to 24 months, possibly sooner, we're going to go to a bank and we're going to go refinance this thing. So once it's stabilized, and this is a very standard practice when it comes to multifamily properties, is once you stabilize the asset, you get the rents. We go off of 90. That's a 90 and 90 rule. If you're 90% occupied for 90 days, you can go to a bank and you can actually do agency debt and get really good terms. I kind of showed these terms. You can see this over the top right-hand side of the page. You can see the rate, the amortization, and the loan amount. So what I'm doing is I'm projecting, hey, when we go to that bank, once this loan is stabilized and I want to refinance and pay back all the investors, and I'm also going to pay back the seller on this, right? And that was why she did this deal as well. Because I said, hey, within 24 months, I'm going to be able to pay you back and give us good terms in the meantime, right? So to show you guys what that looks like, when we pay you everything back, so within 12 to 24 months, you get your entire investment back. So that 1.6 million goes back to the investors, right? So typically on a debt deal, you're done, right? You got your money back, you got your return, and you can go put your money in something else. Well, the beauty of this is you could do that. You could go invest your money in another deal, but you're going to keep getting paid on this deal. So this is what's really cool is our investors are still going to, we're projecting once all the money's given back, and you can kind of see that over on the right-hand side of the page, I underwrote, okay, now let's look at the deal once it's refinanced with the new debt, right? Because when we put new debt on it, the interest rate's going to be higher. But at that point, the property's making more money. So what we're predicting in terms of cash flow, again, once you got all your money back, the investors are going to get around between $22,500 to $50,000 a year in cash flow on this asset. Guys, that is very unique and something, again, typically, if it's a debt deal, you get all your money back, and you're done, and you go reinvest it. But this one, you get to do both. You got to go reinvest your money in another deal, go make return on your money again, and keep getting paid on this deal, right? But what happens if we sell it? This has been a very common question I've got from other investors. And to be clear, my strategy is to stabilize this, refinance, and hold it because I'm going to be very transparent. Myself getting 80% of the profits once I give all the money back, that's very beneficial to me. So I want to hang on to that asset. Now, that said, everything's always for sale. If we get a crazy offer in 3 years, are we going to take that? I mean, yeah, if it's a great offer, we're going to. So I want to show you guys what that would look like on the back end. So when it gets sold, you still have a 20% equity. So how much money can you expect, right? So this box right here, this highlights the exit scenarios. So you can see the cap rate. So I'm not going to go too deep on this, but multifamily properties are evaluated based on a cap rate. So I ran several different scenarios based on a 5 cap rate all the way down to a 10 cap rate. I circled, or you can kind of see a line, a bold line over the 8% cap rate. I think 8% is a very conservative number of what we can expect for a cap rate. I think it's going to be better than that, but I think that's a good conservative number. So you can see on that how much this asset will be worth in, again, whenever that's sold, right? So that's a whole nother presentation diving into cap rate, but hopefully that gives you enough to understand, hey, how much is this property going to be worth? But now let's go look at that. What does 20% of that look like? So again, I've highlighted that 8% cap rate. So based on a 20% equity cash out at the end of this deal, that's potentially $261,000 coming to the investors when we sell this thing. So again, you're going to get paid. It'll be quarterly. Once we pay you out, it's going to be paid quarterly from the start, right? But once we cash you out, you get all your money back and you stay in the deal at 20%, you're going to get the cash flow quarterly. But say we sell in 2 or 3 or 5 or who knows how many years, this is what you could potentially expect to get paid on it. And this is our 3 scenarios. This is our base case, our stretch, and our short-term rental. So you can see that all the different ways you guys are going to get paid on this. And this is, again, why it's a very unique deal. And yeah, just because we've gotten such good terms that we've negotiated, we've been able to pass that along to our investors, which is really cool. The next thing I wanted to share with you guys is what makes us unique. What is kind of special about our company? So I talked at the beginning of the presentation about how we're vertically integrated, how we have a company that goes direct to seller to find the deals, how we have in-house construction crews, and how we do property management. That is a huge differentiator because there's not many people that can all do all 3. Typically, a company could do one of those, and then they're going to have to go outsource property management, or they're going to have to outsource the contractors. That is incredibly valuable on this deal, guys, because think about it. Most other funds or other investments you look at, they're going to go pay a contractor. Well, now they're at the mercy of that. I mean, there's only so much control you can have over a general contractor and subcontractors, right? So because they're in-house, that's a huge value we bring to our investors. And then the other piece is property management. A lot of companies will just go hire a property manager. Well, we do this in-house. So if we're not getting what we want, all I got to do is hop on a meeting with my property management team and we can get things fixed quickly, which is a big reason why I brought that component into our vertically integrated company. The second thing is when it comes to the underwriting and transparency with the investor. Hopefully you guys are seeing today that I want to be very transparent with how we underwrite the deals. I've had a ton of investors that come to me because they just want to understand how to do deals. And I feel like they've just given me feedback about a lot of other funds or other investments they've done. It's been kind of a black box. They didn't understand exactly what they're getting into. But we're literally going to share our Google sheet so you can go see the math and you can look at exactly how we're underwriting this deal. And then along the way, if you have questions, I encourage, we really have wanted to create a community for our investors to where, I think it's awesome if you're a new investor and you want to eventually buy your own properties. I would love to have people come in and participate on a deal like this and see how it goes, understand the underwriting, look at all the numbers so they're prepared. Maybe when we cash you out at the end of this, you're able to stay in as the 20%, and then you can use your money that you just got back and go buy your own deal. I think that would be super cool. And the last thing is our market share. We have such a strong market share in Wyoming because we cover the entire state. We market across the state. We have contractors across the state. We know agents and some of the best experts in Wyoming. Just because we do so much volume, it brings us a ton of value. And the cool thing is we get to pass that along to our investors on this. I wanted to quickly share our organization chart so you can kind of see how our team is built out. Because it's really important, I think. Some operators are just kind of a lone wolf or a one-man show, and I think that can be great. But what I found over the years has been very powerful is building out my team, right? So you can see myself as a CEO and visionary on the top, right? The next step down is my COO and project manager and integrator. That's Clint Warren. You guys will see him in some of the pictures. He's been doing a great job. He works directly with those contractors that are going to be fixing up this property, all right? Then over here, you can see on the right-hand side, you can see our property management team, which is led by Monica Lopez. And then you can see the other, a lot of these other workers are virtual assistants that work for her under her team, all right? Then on the other side, you can see the sales team. So I'm still very involved in negotiating and helping the deals get done on the sales team, but then you can kind of see my lead manager, Judith Allen, and you can also see our virtual assistants that help on the sales side. At the very bottom, you can kind of see our marketing team. That's who really helps us. That's who's going to help us to where we're going to develop this video today that hopefully you're watching, and they're going to help share with you guys. We just like to, back to the transparency thing, we like to share all the deals we're doing. I'm very active on social media. You're going to see what projects are doing. You're going to see updates on this one by just following me, right? If I'm going up to Wyoming and I'm walking this, I'm going to be posting about it. We're going to be talking about how exciting this deal is. So our marketing team allows us to do that. And then the last one in here is the project management team. Again, this team is being led by Clint Warren, our COO, but you can see the different contractors we have throughout the state. And one that's not on here is our mobile crew, which you guys saw, which is the guys that you saw this on the slide earlier, the guys that came up from Houston. So those guys fall under this part of our company. Now, all of these people, we make sure they adhere to our 3 core values, which are ownership, humility, and perseverance. I'm not going to dive into that, but that's just a really important thing we have in our company. When it comes to transparency and showing you guys like track record, what we like to do is we share this Google sheet with anybody. So you can go in here, you can see all the deals that we've done. You can see how profitable they were, what we bought it for. I also like to share, hey, what was the investor terms on it? Was it debt at 12%, or how do we structure different things? So I think it's really important to show you like over time, like how many deals we've done, to where you guys can go drill in and see like multiple deals we've done. And along with that, we like to share our project book. This is more of a qualitative look at it. Still shows the numbers on each deal, but kind of shows you the pictures and gives you a feel for more of the projects we've done. Now, you might be asking yourself, why do I feel so confident in this deal? What makes me confident in my rehab budget, in my timelines? And the answer is this case study right here, guys. Our contractors are literally stepping out from that job and moving right into this one. Actually, one of our guys who worked at this exact project over the last 12 months is actually relocating from this asset here. And he's going to be down in Evanston to help kind of be a liaison and help my project manager and help the contractors and help the property managers to go execute on this project. But to show you guys why we have confidence, I want to really dive into the numbers of this deal. So we bought this project. A lot of you may, if you follow my social media or been watching what we've been doing, you've probably seen this one. We bought this one last June. It was June 30th, 2023. We closed on this. This was 63 units in Casper, Wyoming. Guys, the parallels between this project and the one we're looking at, Lilac Way, it's incredible. Even like the timeline and how things happen, it's very similar. But I will tell you this, the one big difference between this deal and Lilac Way is the terms, right? This deal was a great value add and it's been great for us, but it did not have the phenomenal terms that I was able to negotiate it on with Lilac Way. On this deal, we had to go through a traditional bank, right? So we're paying a higher interest rate, was much more difficult to put together than versus Lilac Way. The seller is giving us phenomenal terms. I don't think I highlighted this earlier, but we're paying 5% interest only payments to the seller who's carrying us that $2.125 million loan. That's at 5% interest only. That's phenomenal in today's interest rates. If we went to a bank right now, we'd be borrowing on a deal like this, on a construction loan, we'd probably be looking at 8 to 10%. So this is phenomenal terms. But again, back to this deal in Casper to show you why we're confident. We bought this for $3.2 million. We put around $825,000 into the units. When we looked at it, there were 55 units that we did some work to. And again, that was from a small scope to a tenant moving out, cleaning it up, doing carpet and paint and making it look nicer, to like a full construction where we had to do drywall, we had to redo a kitchen, we had to do bathrooms, we had to do plumbing, we had to do windows. We've done a lot of work at this project, right? But it's a big scope, just like Lilac Way. As I showed you back to when we were estimating, we've got some units that don't need a whole lot. We've got other units that need a lot of work. One thing worth highlighting is the timeline for this project. So as I mentioned, we started in June of last year. We're actually, this month, we're just wrapping up the construction. So we're going to get 55 units done in 12 months. The other big piece of this is this was our first really large multifamily property. We didn't have a team built out. We had to build out a team in real time to go take on these units. And we had a lot of inefficiencies early on, like finding the right guys for the job. But now we've got a great team and they've been humming along. And we standardized. There's just so many different things as you do a big project like this that you start to standardize. And the beauty of that is we're bringing those same SOPs, those same efficiencies right into Lilac Way, which is going to make it even better. But to kind of wrap up how much value we drove on this deal, one of our units, this actually appraised several months ago. And this was before we were still halfway through the project. And this was a unit in one of the buildings that was in our building that still, like, we hadn't even updated the common areas. Like, it still doesn't look very pretty in there. But the property appraised for $90,000. This was one unit for $90,000. So I think the value is actually higher than 90 because we hadn't even finished everything inside and outside of the building. But if you just take the math on that, if we multiply 90,000 times all the units, and based on what we put, so we got in at 3.2, we put in 825,000. If you subtract that total amount from 90,000 times the 63 units, we created $1.64 million. Like, that's an incredible amount of value that we created in 12 months. It's one of my most proud projects that we've done to date. And again, guys, I'm just so excited to go apply this exact same strategy on Lilac Way. So finally, let's talk about next steps. If you're interested, hopefully you've watched this presentation. We will share the slide deck with you guys if you want to dive deeper there. As mentioned, we also have our track record and our project book, so you can look at all those different materials. The one last material that I haven't talked about is our deal disclosure document. So if you're ready to move forward, you'll need to go read through that document and understand that. That's going to talk about, again, all the numbers I talked about, all the loan amounts, the 80-20 split, the fixed 6%, all those different things are going to be outlined in the deal disclosure document. Okay. So the next step is let's hop on a call. I'm sure you're going to probably have some follow-up questions after watching this, and who knows, everyone has a unique situation, and I'd love to get on the call and ultimately make sure this investment is the right fit for you. So let's say that you're ready to go. You're going to go set up an account on our portal. And if you maybe you already have, but I'm going to show you a slide in my last slide here in a second to show you what that looks like. But so you're going to go to avestor.com and you're going to create an account on our portal, and you're going to be able to see this deal on there. So you can go in there, you can see all the documents. And this is where you're actually going to go in and electronically sign all the documents. For example, the deal disclosure and any other necessary documents. This Avestor platform, our portal, is a really cool thing where you're going to be able to, that's where you're going to be able to actually wire your money into. That's where you're going to be able to look at the financials. You're going to get, this is going to be an ongoing portal that you're going to have access to get all your project updates. And if you want to invest in a future deal, we'll have all of our other deals on the same platform. So a really, really, really cool software. As I mentioned, wiring funds, you'll go through the portal when that's all ready. And then once that's all done, you're into the deal. And yeah, you just get to now keep track of it and reap all the benefits. Guys, as I mentioned, you get to combine debt and equity. You hardly ever get to see that. So once you sign all your documents to the portal and you've wired in your funds, then boom, you're a part of the fund. Congratulations. I'm excited for you to come along this journey on Lilac Way with us. So last slide here I want to share with you guys is, again, this kind of shows you on the left-hand side, our portal, where you're going to have a login to where you can see updates. And if you guys want some other resources, I shared a link here, right? So this link, this QR code is going to take you, and there are going to be several different videos I could share with you. The one I've got a screenshot with here is it's a deeper dive into what we talk about today. I talk a lot about like what investing in real estate looks like and kind of compare like investing in the stock market to alternative investment options and like how real estate can play into that. And then I talk a lot more about like what's unique about our team and kind of our track record and a lot more case studies. Today I showed you the big multifamily case study in Casper, but I also go into some of our fix and flips. And really it's just a comprehensive look in, hey, what does it look like to invest in Bighorn Capital Fund? So I encourage you guys, if you want to learn a little bit more, go to this link and check that video out. And if you guys have any other questions, this same link is going to allow you to book a call with me. It's going to have my 15-minute link through Calendly. So I encourage you guys, click on that, book a call. And hey, let's get you set up. I would love nothing more than be able to help you guys get into an investment like this where you go in and you're secured by debt and you get the long-term equity. Like I said earlier, one of my favorite things is people come into a deal like this. To wrap this all up, guys, I'm excited for you to get into an investment where you're going to be secured with a first lien position. You're going to have the opportunity to get all your capital back in 12 to 24 months. And my hope is that you learn a lot through this investment. You learn how we do the underwriting. You understand our system. You understand the deal to where when you get your capital back, you feel comfortable maybe going and doing another investment with Bighorn Capital Fund, or maybe you're going to be ready to go buy your own real estate investment. I think that would be super cool. So guys, book a call. Let's chat. I'm excited to help you in creating long-term wealth.